I'm Steve. In this explainer, we are going to tackle Fibonacci retracements. Now, before you start having flashbacks to high school math class, let's just get one thing straight. This is all about market psychology. We're going to break down one of the most powerful tools you can have for timing your entries. So let's get right into it.
You know the feeling, right? We've all been there. You see a market just launch like a rocket, and that fear of missing out, that FOMO, it's just overwhelming. So you jump in only to watch in total frustration as you buy the absolute top right before a nasty pullback. So how do you catch the trend without chasing the absolute peak? Well, the answer lies in understanding the market's natural rhythm.
And this right here, this captures a fundamental truth. See, markets don't move in straight lines. They just don't. They move in waves. You get an expansion. That's the big, powerful move up. And that's always followed by a retracement, where the market kind of pulls back to catch its breath. Mastering this rhythm, that's the whole key.
And this is exactly where the Fibonacci tool comes in. The best way to think of it is as an invisible ruler. Seriously. But it doesn't measure inches or centimeters, it measures the market's collective psychology, that constant push and pull between greed and fear. It helps us predict where that pullback is likely to stop, so we can prepare our entry with some real confidence.
Okay, so how do we actually use this invisible ruler? It all starts with finding the right wave to measure. On any chart, you've got to identify some clear anchor points that define the move you want to analyze. Let's just walk through exactly how you do that.
It's really simple. To use this tool, first you find a clear, obvious move. We call this a swing. Then you just click your Fibonacci tool at the absolute bottom of that move, we call that the swing low, and you drag it all the way up to the absolute top, the swing high. That's it. The tool does the rest. It automatically divides that move into these key percentage levels.
Let's apply this to a real chart. Make it practical. Imagine a strong upward move, like the one you see here. That's our wave. So for a current example, as of right now, you could look at the micro E-mini S&P futures, the /MES, after a big run from say 6,800 up to 6,949. Once we've drawn our Fibonacci levels from the bottom of that move to the top, our job is just to wait and watch. We're looking for signs that buyers are stepping back in at one of these key levels to push the price even higher.
So once those Fibonacci lines are on your chart, they create a kind of treasure map. But, a map is pretty useless if you can't read it. Each one of these lines represents a potential support zone, and understanding which ones matter most, well, that's what separates the amateurs from the pros.
Now, there are several levels, but three are absolutely critical. First is the 38.2% level. In an extremely strong, aggressive trend, the price might only pull back this far before it takes off again. Next is the 50% level. Now, it's not a true Fibonacci number, but it is a huge psychological level. It's the halfway point, and big institutions often place their orders right there. But the most important level of all is the 61.8% level. We call this the golden pocket. This is the line in the sand. It's the most common and respected area for a healthy trend to find support before continuing its move. And you gotta pay close attention here. If the price bounces at the golden pocket, the trend is considered strong. If it breaks decisively below this level, well, that original upward move is probably over.
Now, here is my personal rule, and this is critical. A Fibonacci level by itself is just a line on a map. It becomes powerful when it lines up with something else. This is what we call confluence. So, for example, if that 50% level also happens to be a previous support level, or maybe it lines up perfectly with a major trend line, the probability of a bounce there just increases dramatically. And that's not a coincidence, that is a high probability setup.
At this point, you might be a little skeptical. I get it. It can feel a bit like financial astrology. Why should a mathematical sequence discovered centuries ago have any real impact on today's high-speed digital markets? Well, the answer has less to do with ancient magic and a lot more to do with modern code.
It is a fair question. Why does 12th century math work in the markets today? It seems totally illogical, right? Until you understand who, or more importantly, what, is actually moving the price.
Here's the secret. It works because it's a self-fulfilling prophecy. The big boys, we're talking the hedge funds, the major financial institutions, they program their automated trading algorithms to buy and sell at these exact Fibonacci levels. So when billions of dollars in algorithmic orders are just sitting there, waiting to trigger at the 61.8% level, it creates this massive wall of buy pressure. It turns the theoretical line into a very, very real floor of support.
So what is the ultimate takeaway here? What does this all mean for you? This tool provides a fundamental shift in how you approach the market. It is about taking the emotion and all the guesswork out of your entries and replacing it with an objective, repeatable process.
So here is the new rule for your trading. Stop guessing where a pullback is going to end. Start measuring it. Use the Fibonacci ruler to identify that high probability sale price and stop chasing the market at retail. I'm Steve. Respect the math, and I'll see you at the open.